All right, so yesterday we learned that the budget deficit for August, folks, hold on to your hat. It swelled $381 billion. That was the deficit. So the government took in $307 billion and spent $688 billion. My next guest says the Congressional Budget Office projects structurally high deficits forever unless it's meaningfully addressed. I want to bring in now Lyn Alden Investment Strategy founder Lyn Alden. Lyn, you wrote that the conservative baseline calls for over $20 trillion in net new public debt additions over the next 10 years. And, it's so crazy because the numbers sound nuts. And yet there are folks out there that say, don't worry about this kind of stuff. Every time we sell treasuries, buyers step up. It's not a problem. What are they missing?
I think they're missing the fact that we don't have structurally falling interest rates anymore. And so, to some of these critics' credit, there were people that called for debt problems 30 years ago, and they were early because we had this really long period of falling interest rates. So the falling interest rates offset the rising debt levels. I think the big challenge going forward is we don't have those falling interest rates anymore. Even if we just chop around sideways from here on out, in kind of a narrow band, the interest expense keeps increasing from here. And I think it becomes probably a bigger deal. I think people learned the wrong lesson from that past 30 years.
So you've been writing about fiscal dominance for a few years now, really, a lot more intensely. And I'm fascinated by it. I'm also terrified, though, by the numbers and also terrified by the lack of public awareness. Just, talk to us a little bit because you outlined 6 items on why deficits are so sticky and how we've gotten to this problem. Share it with the audience.
Right. So a lot of it is built in over decades. So Social Security, the way it was designed many decades ago, did not really account for slowing population growth. And so when they project out what that's going to look like, there's fewer people paying in for every retiree. And so that's expected to run dry by 2035. We have the highest per capita healthcare costs in the world. A lot of that's on the government ledger, and we don't really have higher average care quality to show for it. So we have kind of inefficient administration overhead in our healthcare system. Very large military expense, a number of different factors, and now interest expense is actually becoming a pretty meaningful item.
Right.
And so as this kind of goes on, it becomes a pretty structural issue.
So listen, to your point, Granny wasn't thrown off the cliff 2 decades ago, right? And everyone's kind of said, okay, it's not a big deal. If it's never addressed, let's just say we keep going the way we're going because we don't have the political will or we just don't wake up. What's the worst possible outcome?
So the worst outcome is that basically the central bank kind of loses control of its ability to do monetary policy, because if you have an illiquid or otherwise unfunctioning treasury market, the Federal Reserve has to come in and essentially backstop it, and then you risk inflation. You risk kind of structurally large fiscal deficits, of which some of it is monetized. And you can go into a pretty significant period of currency debasement. And there's other investors that are kind of looking out. For example, Ray Dalio is concerned 4 or 5 years down the line for that becoming a problem. The exact time frame is hard to measure exactly, but I think we're already seeing around the margins a number of consequences from these very large, big deficits, the inflationary backdrop that they add, and some of the pressures they put on different parts of the economy.
So with that, could that be the thing that trips us up, that takes us from our sort of preeminence, the world's reserve currency, those sort of things that we enjoy right now and perhaps take for granted?
In the long term, yes. I think in the intermediate term, nothing really stops this train. I think this is kind of locked in for quite a while. And it's not like calling for something major by next year or the year after. But I do think that we are now more structurally in this period where we can't necessarily assume that the foreign sector is going to be buying a lot of our treasuries. We can't assume that the private sector is always ready to step in with reasonable yields. And even to the extent that they do, basically anyone holding those is likely to get gradually devalued in terms of their purchasing power over the next 5, 10, 15 years. So I do think it is a longer term issue that has consequences now. And it's, a decade ago, this was a meaningful political item that would come up. They would debate what are we going to do about the deficits. And now one of the things that both parties kind of agree on is not really to cut any of the major spending areas. They've got plenty of other differences, but the major areas of spending and the size are not really being meaningful topics in the current political climate.
And it feels like almost every year there's a new spending plan that maybe it was discretionary, but now we can't cut it. So the areas that cut get smaller and smaller every single year, to your point, no matter which party's in power.
Exactly.
Lyn, great stuff. Really appreciate your work in this. This is a critical thing that everyone should understand and know about. Thank you very much.